Now, amidst the ongoing debate about the magnitude and the timing of a potential global recession, international trade is displaying some signs of stress. Now, while the global trade is indeed under pressure, we deep dive into its impact on India's latest trade numbers and understand the magnitude of its impact on India. Additionally, there's another concern flagged by global agencies which could have far-reaching implications globally. Now, in this episode of The Third Empire, we will look at the escalating concerns around rising global debt. While we do that, we will also look at the latest global GDP predictions released by OECD, which have been surprisingly revised upwards, and look at where India stands amidst key players globally. Lastly, we will look at the list of new sectors which the government intends to provide a boost to via the PLI scheme to aid the sectors and the economy collectively. Stay tuned. You're watching Informed Investor, The Third Empire, an initiative by Research and Ranking. Let's begin. Now, the Ministry of Commerce and Industry has recently released India's foreign trade data. Now, given the decrease in global demand, let's analyze how India's foreign trade has performed in the month of August. India's merchandise trade deficit reached its highest point in 10 months, standing at $24.16 billion, which is a 2.8% decrease compared to the previous year. Now, in August, India's imports of goods amounted to $58.64 billion, marking a 5.2% decline year over year, while exports of goods reached the 3-month high of $34.48 billion, which is down 6.8% compared to the previous year. Now, between April and August of this fiscal year, exports saw a significant contraction of 11.9%, totaling $172.95 billion, while imports during this 5-month period dropped by 12% to $271.83 billion. Now, export categories such as petroleum products, gems and jewelry, chemicals, rice and ready-made garments experienced declines, while engineering goods, electronic goods, cotton yarn, fabrics, iron ore and pharmaceuticals supported export growth in the month of August 2023. Notably, petroleum product exports decreased for the 6th consecutive month, but engineering goods, representing over a quarter of the export portfolio, grew by 7.7% year-on-year after 8 months of contraction. Now, in the month of August 2023, merchandise imports reached $58.6 billion, marking the 7th consecutive month of decline, although the rate of decline slowed down compared to the previous month, largely due to a favorable base effect and a positive momentum. Now, more than 2/5 of the import basket, including items like petroleum oil, lubricants, coal, fertilizer, organic and inorganic chemicals and silver, experienced a year-on-year decline, whereas gold, chemical materials and products, dyeing, tanning and coloring materials, machinery and electronic goods contributed positively. Furthermore, reports indicate a significant increase in gold imports by India, which is the world's 2nd largest consumer of gold, with a surge of approximately 40% in the month of August, driven by the robust festive buying. Now, the value of imported gold rose from $3.5 billion to $4.9 billion year-on-year in the month of August alone. Gold purchases typically rise during the second half of the year due to the festive season, including Diwali, and a host of weddings where gold is considered as an auspicious investment. Now, this anticipated increase in gold purchase during the festive months may help offset a decline in the year's gold consumption, which has been affected by high local prices and reduced discretionary spending. Now, in the services sector too, imports amounted to $13.86 billion, representing an 8.9% year-on-year decline, while service exports also declined by 0.4% year-on-year, totaling to $26.39 billion. Now, in summary, the government has been actively taking measures to control the increasing domestic prices and ensure an ample domestic supply. Now, these measures include imposing export bans on non-basmati rice and levying export duties ranging from 20% to 40% on onions. Furthermore, according to the World Trade Organization, there is a projection of slowdown in global trade growth, which is expected to be around 1.7% in 2023 compared to 2.7% expansion seen in 2022. Now, this subdued outlook for trade is largely attributed to the dim prospects for global demand as indicated by the WTO data. Moreover, amidst the ongoing debate about the magnitude and timing of a potential recession, international trade is displaying significant signs of strain. Now, back at home, from April to August in this fiscal year, exports contracted by 11.9% to reach $172.95 billion, while imports during the 5-month period decreased by 12% to $271.83 billion. Overall, the trade balance for the month of August stood at minus $11.63 billion compared to minus $13.58 billion in the same period last year. Now, while global trade is already showing signs of stress, let's look at another discussion which can be a cause of concern globally, which is that of rising global debt. Now, since the turn of the century in the year 2000, there has been an alarming and continuous surge in global public debt, making it a central cause of concern. Now, the most vulnerable parties in this situation are the low and middle income countries who are grappling with the difficult task of managing their external debt payments while also addressing pressing domestic needs such as food and fuel. Now, in the year 2022, we witnessed instances of Ghana and Sri Lanka defaulting on their external debt following the path set by Zambia, which had defaulted 2 years ago. Currently, Pakistan and Egypt are on the brink of facing similar challenges. Just recently, on 30th June, Pakistan managed to secure a tentative $3 billion funding arrangement with the IMF, which is the International Monetary Fund, providing a glimmer of hope for short-term relief. Now, the latest development in this complex financial situation globally is the fact that global debt has reached an unprecedented high, surging to a staggering $307 trillion in the second quarter of this year. Now, remarkably, this surge is occurring in the face of rising interest rates, which are putting a damper on the bank credit. Now, leading the surge in the debt are economic powerhouses like the US and Japan, as reported by the Institute of International Finance, also known as the IIF. Now, according to this financial services trade group, global debt in terms of US dollars has skyrocketed by an astounding $10 trillion in the first half of 2023 alone. Now, over the past decade, it has ballooned by an astonishing $100 trillion. Now, this recent increase has pushed the global debt to GDP ratio up for the second consecutive quarter, reaching a staggering 336%. Now, the report attributes this rise in the debt ratio to a slowdown in economic growth coupled with a deceleration in price inflation, which has caused nominal GDP to expand at a much slower rate compared to the escalating debt levels. Now, the primary responsibility for this surge in debt lies with countries such as US, the UK, Japan, and France, which collectively contributed to over 80% of the increase in the first half of this year. Conversely, emerging economies like China, India, and Brazil have witnessed significant rise in debt within their respective markets too. Now, the IIF has expressed profound concern regarding the elevated levels of domestic government debt observed in many developing nations. Now, it argues that the current global financial systems are ill-equipped to handle this precarious situation, and to address this issue, the report suggests that a market-oriented approach could be a viable path forward. Such an approach has the potential to assist in managing unsustainable levels of domestic debt and could play a crucial role in directing resources towards development and climate finance. Now, in summary, the global economy is currently navigating perilous waters as global debt reaches historic highs. While mature markets like the US, UK, Japan, and France continue to be the major contributors to the surge in debt, developing economies are also experiencing increases that are ringing alarm bells amongst financial experts. Now, amidst the flurry of economic concerns affecting the global markets, as well as the Indian markets, the OECD has unveiled its most recent GDP projections. Now, let's look at these as well. The OECD has unveiled its most recent GDP projections, which are contrasting them with the earlier forecasts from June in its Economic Outlook Interim Report for September 2023. Now, despite an auspicious commencement to the year, the OECD has downsized its global economic growth expectations for 2024, and these revisions stem from the persistent influence of inflation and a feeble recovery in China. Now, in the year 2023, a stronger than anticipated US economy is serving as a buffer against a global deceleration, although a weakening Chinese economy is anticipated to exert more substantial downward pressure in 2024. After achieving a 3.3% expansion in 2022, global GDP growth is presently on track to decelerate to 3% this year. While this constitutes an improvement from the 2.7% projection in OECD's June outlook, the outlook indicates a further slowdown to 2.7% in 2024, down from the prior estimate of 2.9% in the month of June. Now, turning our focus to the US economy, it is poised to grow by 2.2% this year, an improvement over the 1.6% forecast from June. Now, the resilience of the US growth is evident despite a series of interest rate hikes by the Federal Reserve. However, next year is anticipated to witness a slowdown to 1.3%, a figure that is more optimistic than the 1% projection for 2024, which was put forth in the month of June. Furthermore, the Chinese economy, currently navigating a challenging phase, is expected to witness a decline from 5.1% growth this year to 4.6% growth next year. Now, this slowdown is attributed to waning momentum following the easing of COVID restrictions and ongoing struggles in the property market. Finally, the Indian economy has demonstrated remarkable resilience in the face of a gloomy outlook and prevailing uncertainties. India's growth prospects have been upgraded with expectations of a 6.3% expansion in FY24 compared to a 6% forecast in the month of June. While a dip is projected for the following year in line with global trends, India is expected to grow at 6% in FY25, down from the earlier 7% forecast. Now, while assessing the evaluations of rating agencies for India, most of them anticipate growth surpassing the 6% mark, signifying a significant achievement. Now, Nomura remains the outlier, expecting a growth rate of 5.9%. Now, this places India as the world's fastest growing economy for the current year and the subsequent year as well. Now, the driving forces behind this growth are sustained government capital expenditure, which will stimulate economic expansion, coupled with robust corporate and banking balance sheets that contribute positively to the economic outlook. Nevertheless, India will contend with global headwinds characterized by a pessimistic outlook and stricter financial conditions. Now, despite these challenges, India is poised to maintain its status as the fastest growing economy. Now, in order for us to continue to be the fastest growing economy, the government's role is key in shaping the policies to fuel growth. The production-linked incentive has been one such policy that has garnered significant attention recently and has been the subject of previous discussions as well. Now, allow me to provide a breakdown for you. The central government's PLI scheme is a pivotal component of their strategy to bolster the production of Make in India goods. Now, it's not solely about attracting private investments, but it encompasses a broader objective of increasing overall investments and notably generating more employment opportunities, particularly within the manufacturing sector. Now, the underlying concept behind the PLI scheme is quite intriguing. Firstly, it aims to provide a significant boost to the manufacturing industry. Secondly, it is centered around reducing imports and bolstering India's self-sufficiency. Now, in essence, it represents a contemporary reinterpretation of the traditional notion of import substitution, a strategy adopted by various countries to nurture local industries and enhance economic self-reliance. Now, in some aspects, it embodies a subtle form of protective economic policy. However, the production-linked incentive scheme is not limited to import substitution alone. It also combines elements of export promotion as well. Now, these reforms align with India's China Plus One strategy, which focuses on attracting foreign enterprises seeking to diversify their supply chains beyond China. When the PLI scheme was initially introduced in March 2020, it was directed at three critical sectors, which is mobile manufacturing, electronic components, pharmaceuticals, specifically critical key starting material and active pharmaceutical ingredients, and medical device manufacturing. Fast forward to today, it encompasses a total of 14 sectors with a substantial PLI incentive outlay exceeding 1.9 trillion Indian rupees, equivalent to $23 billion. Now, in an effort to further stimulate domestic manufacturing, the central government is contemplating offering incentives totaling up to 180 billion rupees. Now, this move aims to incorporate 6 new sectors into the PLI scheme, including chemicals, shipping containers, vaccine inputs, toys, bicycles, leather, and footwear. Now, this allocation will be drawn from the original budget allocated to the PLI scheme. The success of the PLI scheme, particularly in the large-scale electronics manufacturing sector for mobile phones, has acted as a catalyst for other industries. Now, according to India's Ministry of Electronics and Information Technology, an astounding 97% of mobile smartphones sold in India are now being manufactured within India. Now, this marks a significant increase from 92% of the smartphones that were imported back in 2014. Furthermore, smartphone exports have seen a remarkable growth of 139% over the past 3 years, and mobile phone production has surged from approximately 60 million in fiscal year 2015 to around 310 million in fiscal year 2022. Now, these figures are truly noteworthy. Nonetheless, it is important to note that it is still premature to provide a final and a full assessment of the PLI scheme. The government remains steadfast in its commitment to ensuring the scheme's success, and it is prepared to take the necessary measures required to achieve this objective. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.